And we're supposedly live. Let's hope so. I am completely confused about what is going on with GameStop, activist trading, everything else. And I brought on a couple experts. Andy Wang, who I've known for a couple of years in the podcasting community, and we've hung out together at different conferences, and his brother Chris. So really, Andy knew that I would struggle with this to a great degree, so he brought backup to help the message sink through. So if you guys would introduce yourselves. Andy.
Thank you, Eric. It's so great to be here on the live stream. Andy Wong, I am managing partner at Runnymede Capital Management. We're financial advisors, and as you'll hear, since Chris is here, we're very much a family-owned and operated business. I'm also host of the Inspired Money podcast.
And I'm Chris Wang, Andy's brother, director of research at Runnymede. I started in the business at College Retirement Equities Fund, which is one of the biggest pension funds in the U.S., serving all the academic world. And I came into the business in 1997 and kind of cut my teeth during the internet bubble. So this has a little bit of a rhyme to it. So there's definitely it's kind of the cycles come back, but this one seems to come back faster and with more speed.
So it's like that Mark Twain quote that history doesn't repeat itself, but it rhymes.
Yes, definitely, for sure.
Okay, well, let's start off with, let me get an obvious question. What exactly is Runnymede Capital?
Okay, I'll start. Runnymede Capital is a fee-only financial advisor. So we work with individuals, families, with business owners, and also some institutions to manage investment portfolios. So typically those portfolios are stocks, bonds, depending on the client's needs and objectives. So some are more aggressive, while others are retired. And then the assignment is then, how do you grow my nest egg safely, protect my nest egg so that I can pay my expenses in retirement? So we do that, do a lot of research at Runnymede Capital. We feel like it's kind of a unique time where doing one's homework matters, but all of us have research backgrounds, so have done research on individual companies as well as trying to assess the risk in the overall market.
So, Chris, do you guys actually invest other people's money, or do you handle the money, or do you advise them, hey, if you're going to do this, go here or do that?
No, we're investment advisors, so we are basically hired to make the buy and sell decisions for our clients. We don't physically touch the money; that their money is custodied at a Fidelity or TD, or an outside custodian where they're kept safe. We just execute the buy and sells for them.
Okay, and it's based on what, a set of directions they have, like if it hits a certain point, sell, if it, things like that. How does that work?
No, I mean, that's all up to us. I mean, we're basing our decisions on investment research, and then we use our own technology to kind of set a price target and a price objective, and then we can decide when to buy and sell.
Yeah, and I'll quickly make the distinction
Sure.
of like the stockbroker that you might work with in the past. You were executing your buy and sell orders through the stockbroker. The stockbroker was being paid a commission. We are not that. We're fee-only investment advisors. So the term that's used is that clients hire us, and then it's a discretionary client relationship whereby they're giving us limited power of attorney, if we get into the legal terms, to execute buy and sell orders on their behalf. So most of them are not wanting to make those day-to-day decisions or the actual buy and sell decisions for their portfolio, and they are outsourcing that to us based on our research and knowledge and ability to do some financial planning to identify what their needs are.
Is it like a subscription? Like I pay you X amount every month and you just handle this stuff.
Yeah, it could be viewed that way because we, being fee only, that means that we never get paid or compensated through a commission. And we think that that puts us on the same side of the table as our clients, meaning that we charge a fee based on the assets being managed. And therefore, our incentive is really to grow those assets or protect those assets. And we're free from potential conflicts where we would be recommending one product over another because one pays a higher commission. That's been eliminated. So we're just paid roughly a 1% fee for managing client accounts and want to grow and protect those accounts.
Now, Chris, are you guys a fund? And I'm asking because your name is Runnymede Capital, and one of the players involved with this is Melvin Capital. And are you the same thing?
We are not the same thing. Melvin Capital is a hedge fund, and we are not a hedge fund. We are registered investment advisors. We run separately managed accounts, so it's not a pooled fund. Hedge funds are basically like a pooled set of assets, like run in one account. And for our clients, they basically have their own accounts. So they'll just see their own assets. It's not a pooled asset. It's all liquid. The hedge fund structure is not as liquid. There's only certain windows where you can take your money out.
Okay, Andy, so help me out. What is the difference between, say, a hedge fund and a mutual fund? And I am going somewhere with these questions. I'm actually trying to lay a groundwork to understand.
Yeah, I think one of the takeaways is how confusing my industry is. My industry loves to create complex products that are difficult for people to understand. And even just the term financial advisor, kind of everyone calls him or herself a financial advisor, and you don't know if that person has a background in research or sales, could be in insurance. So it's all very confusing. To answer your question, there are different like structures or vehicles for investing. So a hedge fund is, as Chris said, it's a commingled fund. It's one fund that's being managed. I would say that the structure is really that there is a limited partner managing this portfolio, and then the investors are limited partners of that fund. And hedge funds also very broad term that could be long, short stocks. It could be only bonds. It could be commodities. It could be futures. The term hedge fund is very broad and does not define what the investment strategy is. There are many, many investment strategies that fall under the term hedge fund. A mutual fund people are very familiar with because if you have a 401k,
right,
most of your choices are mutual funds. Sometimes they're exchange traded funds, but mutual funds are also commingled. It's like one fund, but many small investors can purchase shares of that mutual fund. There's a manager typically that is managing those assets, and very, very common in a 401k. And then what we do, we're investment advisors. We're managing separately managed accounts, which Chris used that term. And that just means that an individual or family or somebody is hiring us to manage a portfolio or account for them. And that account is their account. It's not mixed with any other investors' investments. It's just opening up their own account at a bank or brokerage firm, and then we're managing that for them. So they have full transparency. They see everything they own. They can log into, as Chris gave it as an example, Fidelity. Many of our clients have their accounts at Fidelity because it's a solid discount broker, and they can log in at fidelity.com at any time to see their account.
Perfect. Now I'm going to jump to Chris. I have a question that came in from Locals. I'm on Locals, everybody. If you want to check it out, please do. And I solicit questions from there like I do with YouTube members and things like that. So I just want to put that out there. This question, I think, is really in the back of everyone's mind. So I'm going to jump into it. I'm going to jump back and forth. You know my style. My question would be along the lines of, I can see 2 steps ahead and fear that my 401k and life savings will be wiped out soon. What measurements can I take now to prevent what I think will happen so I can actually retire in 10 to 20 years? And this is from Ava. I hope I'm saying it right. AIVA on Locals.
Yeah, I mean, it's a question about risk. And at Runnymede, I mean, we are always trying to understand risk, and we never want to take too much risk with client assets. I think what I would say is that we don't believe it should ever be an all or nothing approach. And if you're thinking about, oh, I'm fearing that I'm going to get wiped out, maybe you are taking a little bit too much risk, and you can always maybe sell some equities to get a little bit more conservative. But I guess she's thinking in this market, it feels very bubbly. I think we don't disagree. But when we look at the overall market, I would say we see pockets of bubbles. But I think if we look at the broad market, we feel pretty comfortable. Is risk rising? I think we can probably go into it a little bit more. I think there are some risks rising because of potential problems in the hedge fund world, where we've seen a Melvin Capital. I mean, I've heard rumors that they were down 70% in January. I mean, that's a staggering number.
Well, Andy, this is really the result of some activist investing via Reddit, right? That some of this is going on. Are these activists attacking the standard places where people's 401ks are resting, or are they a little bit more specifically targeted, if you will? And to clarify, the thought is that they're sticking it to the man. Are they sticking it to the man, or are they sticking it to all the little men? That's what I mean. Everybody really wants to know this. It's oh, that's great. You know, we don't like that. Maybe they can't get a second yacht. We're happy. But oh, wait, what is that going to be my 401k?
Well, I think there are a few things happening here. And Ava, with her 401k, you just have to make a decision on how much risk you can take if you want to retire in 10 years. And really, the only way to adjust your risk is to make an adjustment of how much stocks you have relative to bonds. And sometimes there's a target date fund in your portfolio, so you can just pick the target date fund the year that you're retiring, and that mix is going to get adjusted for you automatically. So you can take a look at that fund and sort of clue in what is the asset mix, and then you can either invest in that or, you know, reposition your own holdings. To Eric's question, what we're seeing, and Chris referred to the term bubbles, I think there's so many articles that have been written in the last week about David versus Goliath, individuals versus the Wall Street establishment. And that's part of it. I think kind of what we're seeing isn't new in many ways, like investors who are betting that a stock's going to go up, meaning you're betting long on a stock, or
Right.
people
That's
who are betting
traditional, right.
against a stock and they are shorting a stock, meaning that they're borrowing shares at a higher price and hoping to buy it back at a lower price. That's normal. What's new is just the quantity of individuals who are really getting together and sharing information in a subreddit group, in Discord groups, in different places online. And we had like a glimpse of that in 2000 with the internet bubble. I remember that there were Yahoo groups, and before that there were AOL chat rooms. People did talk about investing, but I feel like the numbers have just grown significantly, right? The Wall Street Bets subreddit, even in the last week, has ballooned and exploded. I think when I first went in there last week, there were 3.8 million users, and last night there were over 6 million. I think it was 6.6 million or something. So just the quantity of investors who are able to get together and collectively say, let's buy GameStop, that's new. Like the players have changed a little bit. And can it affect your 401k? I guess it can, but I think what the phenomenon that we are seeing right now is individual investors are very deliberately trying to identify stocks that have high short interest. These are stocks that hedge funds are shorting, that investors do not like, and therefore there are more investors betting against that stock than wanting to be long-term investors. Probably most of these stocks are not in your 401k mutual funds? If they are, they're one of hundreds of positions. So you're very diversified. And I don't think that it's going to impact you in a significant way.
Okay, now, Chris, now I'm going to jump back into time because what reminded me of, I got to get Andy on is you wrote an article, Andy, and I don't know if it was you or Chris who was briefing your investors, but you were talking about GameStop on January 11th before all of this happened. So correct me if I'm wrong. My understanding is that GameStop was being shorted very heavily, but its fundamentals actually were decent. Like there was a lot of signs that it was potentially a good investment. Can you break that down for me, Chris, and correct me if I'm completely off base?
Yeah, sure. I can definitely fill you in on that. Yes, that clip was me talking from we have a quarterly conference call that we host for our clients, and that was on January 11th, and we were talking about GameStop as one of our top ideas for 2021. And GameStop, it really fell on my screen. I remember it from the fall of last year, and I saw that there was the activist investor involved. So Ryan Cohen, who was the co-founder of Chewy, had taken a 10% position, and that kind of jumped off the screen to me because I mean I'd have heard of GameStop before. I hadn't looked at it in a while. I know that it was a darling of many value investors that got run over. They've always tried to catch the bottom on GameStop. And when we started doing research into it, we were pretty shocked by the street was estimating that GameStop would lose money in 2021. And we were actually very surprised by that because there's this console upgrade cycle that the last console upgrade cycle, they had 100% revenue growth in hardware sales. So, I mean, you're going to get this huge boost in console sales. And you're also getting the reopening. During the COVID environment, most of the GameStop stores were closed. So you're getting just this rebound in demand of just reopening the stores. So we think that the company can earn $2.50 to $3 a share when the street thinks they're going to lose money. So we felt like if we entered the stock at $18 to $20, where we did for most of our clients, we felt like you could easily go to $30 to $40 in 2021 just on the console upgrades. And because they would report such great earnings, analysts would have to catch up and revise numbers upwards. So you just have this cycle of upgrades and beats where the stock should outperform. And then on the second point is that with Ryan Cohen on board, he announced that he increased his position to 13%. And he was actually getting a board seat plus 2 other board members that he could appoint. Mm-hmm. So it seemed like he was taking over the company. And we had been investors in Chewy over the past year. Great company. Just it found a niche among pet owners where they spend a lot of discretionary money on their pet. Everyone's dedicated to their pet. He feels like he can do the same thing with gaming. And I think the core gamer has somewhat similar characteristics in that they spend a lot of their discretionary money on games. They're dedicated, and GameStop has 60 million rewards customers that he feels like he can transform the company into something bigger. So for our long-term play, we thought maybe this can be even a bigger stock than $30 to $40, but we don't know how long that'll take to play out because Ryan doesn't take his seat on the board until June. So that's kind of a longer-term play, but instead we hit that target very quickly.
I was going to say, Andy, so you made some money for your clients? Is that what you're saying?
I think that we are among the very few financial advisors managing money for clients who own GameStop. And I hope that Chris provided sort of the backdrop that looking at fundamentals, we can do some research and felt like there was a rational opportunity here. And that's why we did buy some.
Well, fantastic. Okay. One of the comments out there, and I feel like, I should probably get this out there right away because I do want to have full disclosure, blah, blah, blah. I'm assuming that you both have invested in the stock market yourselves personally.
Yes.
Okay.
Yeah.
I have not. So I actually do not have anything in the stock market. Just so next thing, full disclosure, please.
Eric has everything in Bitcoin.
Eric does not have Bitcoin. I don't trust anything anywhere. Okay, so we've got this scenario, and it seems to me, Chris and Andy both, that it's not only you who felt this way about GameStop. Maybe people on Wall Street Bets were actually reading your guidance or listening to you, because I got the impression they felt the same way, or at least some of them, and that they felt that the market was being manipulated by people who were trying to force shorts, and they doubled down on GameStop. And I think that being GameStop, a lot of these people are also gamers. So they probably, Chris mentioned the passion people have with their pets, and there's a similarity. Well, yeah, people are very passionate gamers. So do you think that is possibly what is behind why GameStop kind of became the standard bearer, if you will? And question here is Wall Street Bets exposing how the stock market is being manipulated?
Well, one, I will take zero credit for influencing Wall Street Bets at all, because first, we're too small, and second, I didn't even go into that forum, I think, until a week and a half ago. And I've yet to post. I think what we're seeing is that, as Chris outlined, we saw the potential for earnings to be better than expected, but we did go into the stock knowing that there was a high short position. And knowing that there's a high short interest relative to the total shares outstanding, meaning the total shares available to trade, that if and when those positive earnings revisions came out, the stock is going to move up higher more quickly, because those who hold short positions, in order to get out of those short positions, they have to buy shares. And so the shares are going to go up. They go up faster. I think that investors in groups like Wall Street Bets, they recognize that. They identified that if they can find companies like GameStop, because the short interest was it was over 100%. I think it was 140%.
Which is insanity, is it not?
Which is insanity. And I'm impressed by the investors in Wall Street in the subreddit group, because there is a variety. I mean, out of 6 million people, you're going to have some very smart investors. You're going to have some sophisticated investors who are actually in the business, or they have a background in finance. But then you also have very unsophisticated investors. So I think that the initial idea, I think the premise came from people who were doing their homework and identifying, look, this is a stock that has a high short interest. If we start buying, there's an opportunity to drive it up. If we can share this idea with more people, that's just going to accelerate the buying and the price appreciation, and things will just happen much faster. And I think that that's kind of what you saw. You saw this tremendous momentum, because if you have millions of people getting behind you on your stock idea, even if they're buying in small quantities, and even that ranged. I mean, I think that you had buyers in large quantities, you had buyers in small quantities, but aggregated together, it was significant. And the stock price started moving up very quickly, and that's what we've seen in the last week.
All right, next question. It's from the chat, and it's been here for a while, but really it's kind of a bottom line question. What is short selling? And this is a great way to frame it. In explaining short selling, can you please use the most simplistic example as possible, maybe comparing it to a daily activity that everyone can relate to? Chris.
Comparing it to a daily activity? My gosh, now we have to come up with
It could be cigarettes, it could be beer in my case.
I don't know if I have an example like that.
A gym membership.
Let me come up with, I think I can explain it pretty simple. So let's say Apple stock is selling at $100 a share.
Mhm.
If I feel like the stock is going to end up at 80, I borrow. Say Andy owns 100 shares.
Mhm.
I could borrow his shares and sell them. That's called a short sale. So I have sold 100 shares.
That you don't own.
Yeah, that I don't own at $100.
He borrowed them from me.
I borrowed them from Andy to sell to Eric for $100 because my bet is that the stock is going to go down. So if I'm right and the stock does go down, maybe I'll buy it back from Eric, who's sad that he lost his $20 or he lost 20 points on his 100 shares, and I pocket that. Yeah, I had made money on the short sale.
Okay, I'm gonna try and see if I get it right, Andy. And I'll try with a real object. Like, I like Andy's car, but I think that his car is way overvalued, and that if I borrow his car and I sell his car, I promise to give him the car back in a month. So I borrow it. I promise to give him the car back in a month, and I turn around and I sell his car for $10,000. But then the day before I have to give it back to Andy, I buy the exact same car, but I buy it for $5,000. Is that in essence what's going on? Then I give him back his car and say, here you go, man.
Yes.
Yeah, it's similar. Yeah, and you
That's
pocket
essentially what's happening.
Yeah, and you made your 5,000.
Okay.
But
okay,
if your bet went against you and the price went up, then you lost, right?
Right, because then I'd have, let's say it went $50,000, it'd be like, oh dear, I got to go get a loan from the bank to get $50,000 to
Exactly.
Pay Andy for his car, or give a car to him.
Yeah, I think. Yeah, I'm hard pressed to come up with like a good metaphor, but
it is confusing.
But I think if you just know, like wherever you have a brokerage account, so if you have an account at Fidelity, or you have an account at Robinhood, or you have an account at Schwab, you have a trading account that allows you to buy and sell stocks. Normally, we're only buying stocks, the majority of us.
Mm-hmm. Right, which it does feel this. I think that a lot of people are offended by this principle, and that's sort of why I use that car example. Because
but you're able to do
I'm
the
selling
opposite.
something I don't own. That doesn't
Right.
seem right.
Yeah,
it's like you didn't make it, you didn't earn it. You're selling what you don't have and profiteering off of it. And I think people find that kind of repulsive.
Well, I think it's just a weird idea. But if you have a brokerage account, you may just not be aware. You have the ability to do this, that you can sell a stock that you don't have. Your brokerage firm will lend those shares to you. They actually charge you some interest for lending that to you. So there is some like interest involved. You don't get it for free. You're not getting shares that you don't own for free. There's a cost to it, but you're borrowing it to sell at a certain price. If it goes down lower, you buy it at a lower price. So in essence, you're doing the opposite of what you'd normally be thinking about investing, that you're trying to buy low, sell high. By borrowing shares, you can sell high, buy low. And I think the mechanics of the market, I think market participants will argue that that is a healthy thing for the market because you're providing liquidity that makes sure that when someone wants to buy something, there's always someone willing to sell something. And that means that the whole trading like world is functioning properly. You're not going to have a situation where everyone's trying to buy, you have no sellers, or everyone's trying to sell, you have no buyers, because you really need two sides to keep things moving.
Okay, so I'm going to pick on everybody now. Chris, we'll go here with you. Is this a healthy market if, say, you have a hedge fund manager who has a lot of political sway or value, and he says, he's got a fund, he invests in a bunch of stocks that he plans to short, and then he goes on TV and he says, GameStop's garbage, man. Yeah, that's just garbage. It is a complete garbage stock. It's going to tank. It's horrible. And people are saying, oh, he's on with my favorite expert on television. He's a really, really smart guy. Oh dear, I better sell and cut my losses. Meanwhile, the stock dives, and our short seller has just created potentially a situation where he's profiteering. And some might consider that to be a market manipulation. What do you think of that?
I don't know if I would consider it a market manipulation. I mean, he's talking his book, so yeah, he's talking about what his bets are or what his investments are. I think what you're trying to get at is there's a lot of people saying, is what is going on in the subreddit groups bad or not? Like, is there something improper going on there? And
Actually,
I don't know. I think it's both. Like, is there?
Okay.
Yeah, I think they're comparable, and I don't know if there is an answer. I think on both sides, there's someone trying to make their case of what they're doing, whether that's on Wall Street Bets or on CNBC. I think they're both trying to accomplish the same thing. They're saying maybe they're pitching two sides of the coin. One saying, "Hey, I want to short Bed Bath and Beyond because it's going bankrupt," and on the subreddit they might be saying, "Hey, let's all go buy it because we can squeeze the hedge fund guy." In the market, will I guess it'll all play out in the market, and we'll see who's right. I guess that's the fun part.
I'm not going to pass judgment on, do I think that the hedge fund guy is like, is he being righteous or not?
And he's protecting his kind.
No, I'm gonna, I don't know. I tend to be like pretty cynical a lot of the time, but I want to come at this from like, I'm trying to be as objective as possible. And, you know, there are hedge fund guys who are bad guys. No, okay, right? They're going to be good guys, they're going to be bad guys. But on the whole, I feel like most of the people who are in the hedge fund industry, they are smart people, and they are doing analysis, trying to identify companies that they think are strong and weak, and then they're placing their bets accordingly. You know, I think Melvin Capital, that got into trouble this week, these are not dumb individuals. Like, they did their homework, and they have a record of doing very, very strong research and good work, and then put money behind it. So I don't know. What was your question again? Going back to the original.
No, that's fine.
Are they doing something bad going on TV?
You guys kind of, you've answered it. I'm just putting out there the scenario, and I think a lot of people believe in. And while we're at it, and speaking of grift, I need to make some money here. So I've got super chats coming in. And I'm as guilty as anyone. But Tom Villers asks, and thank you for the super chat, several journalists have tried to link Reddit's Wall Street Bets to MAGA. Is there any political component to this activity? Have either of you heard?
I'm embarrassed to say that I have not read these articles in depth, but I can assume that it means that Reddit, like MAGA, it's a movement. You get a group of people that believe something, and then there is this like group mission to move towards that goal and mission as together. And so I don't know if the journalists are saying that, you know, the Reddit members are MAGA. I don't think that they're the same group, but I think there are similarities in the way that you see a group sort of galvanizing for a cause and trying to do something together. Chris, have you read those articles?
I haven't read it, but I mean, I understand where it's coming from. I think it's like it's almost like you're saying there's a populist movement behind it, and I think you do see, you see signs of that, and there has been this movement of, hey, maybe it's millennials saying, hey, the people that are older than us, they've messed up the climate, they've messed up pretty much the government, messed up the financial situation. Let's stick it. Can we stick it back to them in this way? let's see what we can do. And I don't know, this is going back to Andy's point a long time ago. He was saying that back in the internet bubble, there were people in chat rooms back then. And I think that the difference now is that there's been, because of technology, so much friction has been removed. And back then, when I wanted to make a trade, this is dating me, I had to call a broker to place the trade. There wasn't the E-Trade back then or Fidelity. Now you can trade for free. I mean, someone can buy $5 worth of stock with zero trading cost. Back then, I had to pay $50 to trade. So I mean, I couldn't even conceive of trading 100 or one share of something or $100 of something because I would immediately have a loss. So, I mean, yeah, there's a lot of changes in the structure of the market that has basically helped propel this movement.
One can argue that the playing field is becoming more level as far as people being able to participate.
We're going somewhere with that, by the way. So don't worry, because I'm going to argue the counter in a way, because I'm going to say old world is coming back, but I got to grift a little more, need more money here. What is the difference between short selling and naked short selling, other than mean sexy?
Okay, I think this is getting more advanced because this is referring to, we spoke about like conventional short selling, which is selling the stock, borrowing the stock and selling it short. You can also use options contracts to short or to hedge a position. And when I see the term naked, it screams options market to me. So you can also short using options. You can buy puts, betting that the stock is going to go down. And if you buy a put contract, that gives you the right to purchase the stock at a lower price, and that's called the strike price. If you're using options, sometimes it's because, if we're using GameStop as the example, if you own GameStop and you're worried about it going down, you can buy a put option at a certain price lower than currently, and that way you're buying some protection. That's like insurance, so that if the stock price goes down, you're not just having the value of your stock go down. You have some options that are going to pay you some money if the stock price hits the strike price that's lower. A naked short means that you don't own the shares. You're only betting with an options contract that it's going lower. You don't actually hold the position. So you can do that too. You can bet just
You're
naked
right, it's complex.
short.
I'm already
It gets complicated. So
I think that was one interpretation. The other one is that you're naked short if you don't even borrow the shares, which they deemed that illegal at, I think it was in 2008, because people are just, you could short to an unlimited quantity. They don't want you to do that. Okay. So they banned that.
Okay, so last of my current grift. Explain what a hedge is using sports betting.
All right, I'm going to pass this on to Chris because he's more of the sports guy than me. I'm not that strong in sports.
Neither am I. I'm already like,
I think I would say, okay, I think I can take that one. Okay, so the Super Bowl is coming up. And oh, it's bad. I don't even know who's in the Super Bowl. Tampa Bay against
Chiefs?
Yeah, the Chiefs. So I bet on the Chiefs winning the Super Bowl. And say at halftime they're up 7-0. So I think I'm gonna win on that long bet. Say I bet $100 for the Chiefs to win. But I want to hedge that just in case they lose. So maybe at halftime I bet against the Chiefs. Maybe I bet on Tampa Bay. Maybe I just bet $30. So
it's a side bet.
Yeah, the side bet. So I won't win the maximum amount, but if they lose, yeah, I win a little bit just to offset. So that's kind of a hedge.
Okay. And now, before I get back to grifting, I'm going to go and answer the democratization comment that you made earlier. And Chris, I think, made most of it, and Andy, both of you. But we've just had it proven, and I'll pull up a chat on that, that's actually not true. We have an app in question, Robinhood, and several other apps have all done the same thing. So it's a factor here. And what, in essence, they did is they said, well, you can no longer buy shares of this spread of companies. They called them meme companies or meme stocks, if I recall. And you could sell them, though. So in essence, what they did accomplish was potentially to start getting the price to drive down to help the same hedge funds dig out of their mess. That's the way I understand it to be. I know you guys can set me straight on it, but it doesn't smell very good. And I see some problems. So who do I want to pick on? Who's drawing the short straw?
Did you want me to take that?
Yeah, go for it. You go first.
right.
I'll go second.
This is complex.
More complex than being naked?
Yeah, this is even more complex, which I don't like complex answers. Let's start off. I don't know why Robinhood maybe they didn't explain it very well because it's complex. But what happened was they basically could not allow people to trade because let me set this straight. Okay, so Robinhood, they basically take your orders and they're executed somewhere else.
Mm-hmm.
So there's another intermediary. It's called the NSCC, which is like the clearing corporation. So when you buy GameStop, it takes 2 days to settle. So when you trade on Monday, the trade doesn't settle till Wednesday. So between Monday and Wednesday, there's some credit risk because the trade hasn't settled. So on Robinhood, they take all these trades, buys and sells. They're taking a certain amount of credit risk that they're going to have the money to pay the DTCC. And when there's a little bit of usually there's just a little bit of volatility, so they don't have to put up that much capital. So say there's like $1 billion of trades, 500 million in sales, that nets out to be 500 billion. But if there's very little volatility, they only have to put up like 1% of that. So say they have to put up $5 million. But if a significant people are buying GameStop, say 50% of the new capital coming in wants to buy GameStop, the volatility in that stock is much bigger than the market. Because, I mean, the stock has been going up 100%, so it could go down 100%. So the clearinghouse, they want more capital as a deposit to take on that credit risk. And what happened was basically Robinhood needed $1 billion worth of capital to give to the DTCC to take on credit risk. So they could not, for that one day, they could not allow trading on those stocks because basically
they ran out of money.
The clearing firm would not take any more trades on the security.
They were requiring Robinhood to put up more money because of the increased volatility. And that was money that Robinhood didn't have. So we can have a couple of discussions here because it's a very complicated discussion about this 2-day settlement and what's happening behind the scenes. I think that many observers are looking at that and kind of, it's hard to understand. They don't really care to understand it. And it's easier to look at the surface and say, look, there is an arrangement with Citadel selling data, and therefore Robinhood is going to help the hedge funds out. We don't think that's happening. We think that
it looked like that. I mean, if you just sit there and look at the situation,
that's right.
You know.
Yeah, it definitely seemed like that.
But, and this doesn't make it correct, almost everybody is selling our data to Citadel and other firms like that. You know, it's like Facebook selling our data to, the highest bidder. Similarly,
All bidders. What are you talking about? Why would they stop at one if they could sell it to all of them? Jesus, dude.
similarly, I think all the brokerage firms are selling the flow. That's all the buy and sell information from the clients to hedge funds, and they're using that for their high frequency trading and benefiting off of us. I think it's something that everybody is doing. It's common in the industry, so it's not unique to Robinhood. Could they therefore have an interest to help out the hedge funds? Yes, they could, but I think that the explanation that has come out, in the last couple of days, although not well explained by Robinhood, I think that is the reason that they had to reduce their risk. We saw that Robinhood had to take an additional $1 billion from investors. They were at risk of, having a liquidity problem and potentially going out of business if it became too extreme.
Now, is this the same story with all the other apps? Because from my understanding, it was not just Robinhood that froze it.
That's
Everybody
right.
did.
We heard the CEO of Webull, who I think explained the situation much better than Robinhood initially. But they were experiencing the same issue, and that's why they were restricting some of the GameStop names and like a small list of high volatility names, because they were having the same problem. They were being forced to put up more money as collateral to DTC for this clearing process.
Could DTC be seen as in, I guess, cahoots with the hedge funds, if you will, or whatever? I mean, I'm just wondering, who would get that call out there? Is it possible that they could have been making a political move or play and saying, we're going to help out this end of the industry, and they pressured Robinhood? Is there any way that they could be pressured at all? I have to ask these questions.
Look,
that
if we're talking conspiracies, I guess someone could say the hedge funds are the big client of DTC, the bigger user, so maybe, but I don't think so. DTC is the central securities depository. They're the depository for all stock, like equity securities, like common stocks, municipal and corporate bonds, even money market. They're kind of like the clearinghouse for all of these transactions. I don't think that they are taking a side. I don't think they're taking a side. It's like, because you might have an account at Schwab. Well, okay, not Eric, because he doesn't have any stocks. If our viewer today has an account at Interactive Brokers and I have an account at Fidelity, if I buy and you sell, there's an exchange taking place. Like, there are two institutions. There has to be like a central place. So DTC is that place behind the scenes. So Fidelity sends my buy order information to DTC, and then Interactive Brokers is getting the sell order. So the stocks are sitting there, and then 2 days later, it's like, all right, we figured out the buy, the sell, everything got reconciled. I think DTC is worried that because there's so much volatility and they need to match up orders to make sure that transactions are actually being completed, they're worried that what happens if one side becomes insolvent? Then they can't, then things just freeze up. That means, if that happens, that becomes a systemic risk where buy and sell orders are not able to be completed properly. And DTC, that's why they're raising the collateral requirements, because they want to make sure that all those transactions can be completed. If one side fails, then that's what happened back in the financial crisis. Lehman went bankrupt, and suddenly you had contracts, or options contracts specifically, where you didn't, the other side wasn't there anymore. And then the whole financial system has a problem. It's locked up.
Yeah, Andy explained that well. I mean, this wasn't generated by some phone call. This is regulatory coming out of Dodd-Frank in 2008, where they almost had the system collapse. So they forced the DTC to have collateral, specific collateral, so there's no credit and systemic risk. And that's what's going on here.
And it
Okay.
makes sense. I think it makes sense because the volatility of these stocks are so high. They can go up 100% in a day, they can go down, 60%. And when you have that kind of movement, 2 days is a really long time. So 2 day settlement is like an eternity. It's like so much has changed. What if the stock went down to zero? Like what happened? You've got a settlement problem.
All right. I have a super chat here saying TD Ameritrade reportedly closed people's GameStop position without their knowledge or consent. Is that even legal?
I've heard that. I've seen tweets and I've seen like messages in Reddit about that. Some people claim to have screenshots, but I haven't heard like credible evidence that that has happened. I know that there are journalists who are looking into that.
I haven't
now-
seen that, but the only thing that I would add, not knowing the situation, but if you're on margin and you get a margin call, they have the right to sell your stocks. They can sell anything.
Chris, now you have to define margin.
Thank you.
That's like if that's basically taking on debt to buy, you're taking on leverage in your account. That's like taking on margin. So say I put all of my account in GameStop, but I'm on margin. Say I want to bet 150% of my account on GameStop. So I'm 50% on margin. So if the stock went down, I might get a margin call to settle that debt that I owe. And they can force you to sell it. I don't know if that was what was going on there, but if I had to guess, it would probably be that. And maybe it was on the day where GameStop was down. GameStop was down 50%, I think, in one day. So if someone was on margin, they could be forced to sell.
Okay. I've got a comment in here, and I see a conversation going on the side, but it's kind of against Robinhood here, but saying there's a fundamental difference between selling data for advertising purposes and selling data so it can be used against a person in the game in which both are playing. And I think that's the kind of a pushback on the whole, well, it's free. Well, no, it's not free. Technically, Facebook is not free. They're selling, you're the product.
Yeah.
People using Robinhood technically are the product. I think most would agree, right?
Yeah, I would agree. I mean, there's no free lunch, right? And is it right or wrong? I would agree that the quants shouldn't front run every trade, but they do. And it doesn't really matter which firm you go to, whether it's Fidelity, TD. They all sell your flow to the quants, and they're skimming maybe a portion of a penny off of your trade every time to give you your free trading.
Okay, well, continuing on at Robinhood is selling data to procure an unfair advantage to another player against their own users without disclosing it to their users.
Yeah, I think it's not just Robinhood. I think that all the brokerage firms are doing this. So I think it's important to have that distinction that it's not unique to Robinhood. Everyone's doing it, and me as a consumer, as a retail investor myself, I have a problem with that. Why are certain institutions allowed to buy that information and then use that information to their advantage? If they're skimming a fraction of a penny off of my trade, maybe I don't notice it, but it's still wrong. But the regulators have not stepped in to prohibit that. So it's being done every day.
Okay, so going back on the Robinhood running out of money, whatever the reasons are behind the scenes, do users have recourse? Because to them, in all transparency, it doesn't really matter that Robinhood couldn't get money. It doesn't matter to any of them. It matters that they want to buy that stock. They can't buy that stock. Robinhood is violating the user's terms and service. Essentially, there's a contract between Robinhood and the user of the app. Do these users have any kind of recourse, or what is the answer on this? Do either of you have any ideas?
I mean, I don't think they really have recourse because I mean, Robinhood, it wasn't like it wasn't their decision. So, they were the people that owned GameStop or AMC or these restricted companies they could sell, but they just couldn't buy. I mean, is it an ideal situation? It's definitely not. And I would be shocked as a Robinhood user as well. But
Well, here's the problem.
do I want a lot of systemic risk and risk that this trade is going to collapse the financial market? I would rather not have that.
I guess my problem is this, though. By freezing out, if you will, the Robinhood users who are not institutional, we'll just say they're Main Street for a shortcut. Is that fair?
That's fair.
The Wall Street brokers absolutely could pick up the phone and do whatever they want and buy anytime they want because they have that whole backflow to do it. So in essence, when you shut down all of these apps, you are in effect, whether it's reasonable, otherwise, whatever, you're saying, hey, you're not a player. You're now out of the game. And in essence, the effect is to protect the institutional investors. And that's how it looks.
Yeah. Two things, and then I'll let Chris jump in. I think that's how it appears on the surface. I think that this was an extreme circumstance. It wasn't a matter of Robinhood arbitrarily deciding we're not going to let our users buy GameStop in this list of stocks. It was because DTC raised the collateral requirement. They didn't have that cash. So they had to make restrictions to control their own risk as a company. Mm-hmm. And I think that the users should care, because if Robinhood became insolvent and had to declare bankruptcy, if you look at MF Global as an example, MF Global went bankrupt, and people who were trading through that, some of them didn't get 100% of their accounts back. Like, they lost some of the money in their accounts. So in that sense, the users should care about Robinhood. When it comes to Robinhood making restrictions and Wall Street working with firms that didn't make restrictions, that one's really hard because it was a case-by-case basis which companies were putting restrictions in place. To my knowledge, Fidelity did not. So one could make the argument that an individual could open up an account at Fidelity and find another brokerage firm that wasn't experiencing like a liquidity problem and putting restrictions in.
Yeah, I would just add that you better know who your custodian is. I mean, that's basically what Andy is saying with that MF Global example. The reason why Robinhood had problems is because they weren't capitalized enough. So if you were at Fidelity or TD, and anyone can be, you could have traded. It's kind of like going to Bed Bath & Beyond and getting mad that they don't have a product that's on Amazon. Are you going to get mad at that? I think you just have to go to a different store. Okay. So, yeah.
I have a super chat here. I don't really understand what exactly he's asking, but I know it'll make sense to you guys. So, is there a POSS, for gamma squeeze to occur for GME or GameStop? What was the purpose for the $320 price, and how would it relate to the options expiring 131? This sounds like a math equation, and I am completely lost.
All right, Chris, we're really going to get confusing now. Can you take this at all, or you want me to jump in?
I don't think no, I'm just gonna. I mean, we're not options traders. I don't think I really want to get involved in that. But I mean, there is definitely. Andy can take a crack at it, but I mean, there are definitely a lot of games that are played going into options expiration, I would say.
Okay, yes. So it's way out of the scope. That's
well, yeah. I was going to preface by saying, yes, same as Chris. We are not options investors, so we are not experts. But I think if we look at what happened to GameStop over the last week and a half, I think it's two things. You have the Reddit investors driving the stock up, so you had a short squeeze. I think you had two types of squeezes. you had a short squeeze, meaning that the stock price started rising sharply, and anybody with a short position had to seriously consider, do they get out? Otherwise, they're going to suffer potential large losses. So they have to buy stock. They have to cover their short. The stock goes up. That's called a short squeeze. There's a gamma squeeze too, since the term gamma was used. Not only is there a high volume of buying being taken place on GameStop stock, there's also options contracts with very high volume. And people are essentially betting that the stock's going higher. They're buying call options, which gives them the right to buy the stock at a higher price as of a certain date. And usually, I mentioned that there's like, if you are with an options contract, there has to be someone on the other side. It's a contract between two parties. And most often it's not with two individuals. So if I'm buying a call option, the other side is usually a market maker. And if the price is rising really quickly and I'm buying calls, the market maker has to sell me that call to protect the market maker because he doesn't want to be naked. Naked, remember naked?
Naked. All right.
To control that risk. So, all right. This is so confusing. All right.
I'm already just, my mind's wandering, guys. I'm assuming you're answering for the one person who knows what they're asking. But,
I'm going to get this out quickly. So if GameStop's at 300 and I think it's going higher, I can buy a call with a strike price of 320, meaning that I think that it can go, it gives me the right to buy the stock at 320. I'm buying calls. On the other side of that contract is the market maker who is selling it to me. The market maker is now exposed to my bet that it's going to go up. To protect or hedge him or herself, the market maker will buy the underlying stock, GameStop, because that way, if it goes up, then the market maker is not facing that risk. Because if it hits 320 and I have that right to buy the stock, the market maker has to deliver that stock to me. And so therefore, before it gets there, the market maker is going to buy the underlying stock so they can deliver that to me in the future. That's a squeeze too. That's called gamma risk. That gamma risk, they are trying to buy the underlying stock to reduce the gamma risk. And that gamma squeeze is also driving the stock up faster and higher. I don't know if that makes sense, but there are like two big things happening that drive the stock up at the rate that we saw. And that's a short squeeze and a gamma squeeze.
So it sounds like everybody's scrambling and that is causing the volatility. Is this essentially what you're saying is a call option might help protect a short position or counter it? Is that the idea?
Chris?
Yeah, the easy answer is yes, because I mean, that's your bet that the stock price would rise. But the problem is when you have high volatility, the cost of the call option increases by a lot. So your cost of protecting that short position is going to increase.
Okay, well, awesome. And folks, there's 500 plus people watching.
How many of you own GameStop?
Good question. But out of those 500, there's only 100 and some odd likes. Please go ahead and just hit the like button. If you're not subscribed, please subscribe, because this really does help and it helps push this out for more people to see. Andy needs more audience for Inspire Money. We got to put the word out.
Thanks for that, Eric. I think that one really sort of silver lining around this, or the bright spot that I've seen in reading different tweets and different online posts, is when you have the individual who has benefited by the rise of GameStop. This is transforming people's lives. I'm seeing people who are able to pay off their student debt, or they're out of work and now they can pay their expenses and their rent. I think that that's a positive. Like we said, the democratization, to have lower barriers to entry for people to invest in the market, that's a big positive. I think that Where one needs to be very, very careful is that there is a distinction between investing and speculating. And Chris and I and our firm came to GameStop with the belief that we are investors. And at $20, I still feel that we were investing in GameStop when it's 3 digits, and at 300, it turned into speculation, and the risk rises exponentially. And it can be very dangerous because things can turn quickly. You don't know when it is. Bubbles are dangerous in that it's very hard to know the timing or the, I guess, the like depth and size of like a market correction when there's a bubble, when the bubble finally pops. So just be careful.
Well, that's where the activist comes in, though. I mean, I do think there are potentially some people out there who have one share and they're fine at losing that $300 because that to them, they're paying $300 to make a statement against somebody. And I think this is a unique scenario in that regard. So, yeah, you're right. A lot of people are going to lose their investment, especially those who are buying high. And I wonder if, or I'm of the understanding, a lot of them are saying, yeah, this is like me taking out an ad in the paper saying, screw you guys, I hate you. It's worth $300 to me. So that's
I think I'm a really
weird...
frugal guy. I don't want to lose $300.
Well, I hear you, but I'm just saying that is a component. And have you ever seen that component before?
I think that's where it is different. And, you know, maybe that's where you make a MAGA analogy that...
or populism. Sure.
Yeah, that like the populist is trying to make a statement. That's very different from both investing or speculation.
So how, and this brings up another question on locals, but it's along that same line. And it's essentially from Buffalo 17. Please discuss hypotheticals on how to short squeeze, for example, silver futures or whatever, strategy discussion, or why this is a wonderful thing that is happening. Now, I'm not going to go deep into how to, because I don't think it's really responsible for you to say, okay, this is how you go about doing it. But I wanted to bring that question up because that's sort of what we're discussing right now. The sentiment in that question is, this is awesome. I love it. Finally, you know, never mind Occupy Wall Street. That just prevented people from getting into buildings. It's kind of annoying. It's really messy. And, you know, a lot of people got hurt. This is a very strategic, targeted, scarily effective attack, some would say. What do you guys think?
I think it's very, I don't know. I mean, there's this populist angle, but I think people are greedy. A lot of the stories are about people that made I just saw a story today that was, I didn't listen to it, but the guy invested like $4,500 in call options and made $1 million. Wow. So that's like appealing to people's greed. People are I mean, they do want to send a message that we're against a lot of what has gone on and maybe in financial markets, but they also, I think, are pulled by that level of, oh my God, I could have made 10 times, 20 times my money in a short order. And I kind of feel like now the chase is on. Everyone is doing a search for most shorted stocks. The other day I did a search, and I think there was so much traffic going to that site that it wouldn't open. So people are just looking for that quick buck, and we're all attracted. It's hard not to be attracted to it. It's like the lottery ticket, right? We all dream of transforming our financial situation overnight. Okay. I mean, that's kind of on the other side of being, it is speculation. It's dangerous. But yeah.
I feel like I was already overstepping my area of expertise in talking about gamma squeezes to give a how-to tutorial on how to drive silver futures up using options, that is completely out of my
So in other words, they
Out
need
of-
to get an
out of
account
my
with you guys
headspace.
and hire you
No,
to do the research.
I think what's really interesting, it goes back to Chris saying that like he tried looking up the short interest website and couldn't even get in.
Right.
I think that this is like this has been a short-term phenomenon, and we don't know how long it's going to last. I saw an interesting figure that I think as of Friday that like high short interest stocks versus low interest stocks over the last 3 months, the high short interest stocks were up 33%, and the low short interest stocks were up 14%. That's not normal. I think if you go back and look at data over history, the high interest short stocks usually do poorly over time. That the people who are betting against companies, usually they're doing their research and it bears
There's a
out.
reason.
Yeah, there's a reason. I mean, even with GameStop, we saw an opportunity in 2021, but that's not to say that this company isn't going to eventually go away. It could be the next Blockbuster. We just felt like it wasn't Blockbuster yet. Time will tell whether this is going to be a turnaround story with the new management. We don't know. But going back to the silver question, which I probably shouldn't even talk about, but I just want to remind people that this isn't new. Back in the early 1970s, you had the Hunt brothers who believed that they could corner the silver market. And this isn't dissimilar from some of the things we're talking about today. I mean, you're talking about market manipulation. Can you manipulate the price of some kind of asset, whether that's a stock or a commodity, to your benefit? And I think that the lesson of the Hunt brothers is a good one because they believed that they could corner the silver market. They tried buying up as much as they could. And I think in the near term, it looked like it was working, and then the whole thing blew up on them. So eventually, like short-term market forces, they don't last forever. And that's what you need to be careful of, right? Even this like short-term interest bubble piling into a stock that has a high short interest, it may have worked last week, but it's not going to work forever. So beware.
How about Nokia? Friend of the channel, Viva Fry, said he bought some of them. Is that a decent looking stock on this?
I heard Portnoy from Barstool Sports talking about the knock. I just get a kick out of the fact that he calls Nokia the knock. I'm not sure if I should be like confused or think that's awesome. But Nokia is a name that we haven't followed in a long time. I'm sure that Chris can speak more intelligently about that than I can.
I mean, the complexity of shorting or looking for things that have high short interest is a name like Nokia. This thing trades on different exchanges. It's not even a U.S. listed. I mean, it's not even a U.S. domiciled company, right? So, well, maybe it is now because of all the acquisitions, but I think it trades in Norway. It trades in all these different places. I don't know if it's going to have the same effect on buying Nokia as in GameStop. And it's a much bigger company. Maybe not now, but it's like $27 billion market cap. If I was in that subreddit group, I'd be looking for very small companies where 1 million people can move the stock. Like you look for micro cap stocks with high short interest. Or
yes, and if I put my compliance hat on, that is not a tutorial or a how-to.
Well, don't worry, I'll cut that part out, Andy. Yeah, we'll amplify it. I mean, we'll do a little audiograms that are. All right, super chat. I like the idea of GameStop transitioning to a gaming/land type of micro center, Newberry Comics hybrid, in-house fun plus pop culture plus gaming hardware. I think Tim Pool was talking about that, and that seems like a way to kind of hybridize over to online and offline, both.
Yeah, I think that's the vision that that Ryan Cohen is potentially painting. And that's why he invested 76 million into GameStop, because he believes that there's an opportunity there for him. But we're so far away from that vision. As Chris mentioned earlier, Ryan doesn't even join the board until June, so he's not even really there yet.
Well, it's not like they can do it until then anyway, with COVID issues and whatever else. So, I mean,
And even
it sounds like a long-term bet, and
it's a long-term bet. And
we'll
even
see.
if the company can be transformed and change over time, should it be trading at 300 right now?
Well,
Probably not. But we're also living in a world where, Tesla price to sales is very high. So, could GameStop sell at a very high price to sales for a while? It could.
okay, well,
I think the interesting story is what this huge valuation all of a sudden for GameStop is. They can do a lot with their paper.
Yes.
All
they
of a
have
sudden,
currency.
I was going to
yeah.
say, could they acquire somebody with
Oh,
this?
totally. I mean, you
Stock swap
remember
or something, just to, and then fortify themselves by buying out, like say Nintendo.
100%. I mean, you remember back in 2000, AOL used their paper to buy Time Warner. I mean, they used their expensive paper to buy real assets. And if GameStop keeps on appreciating, all of a sudden Ryan Cohen has a currency that has a lot of value. And if you look at the software makers, I was just looking today, Take-Two Interactive, which makes Grand Theft Auto and other popular titles, they're trading at the same market cap. So like if this doubles or triples from here, he could use that paper to try and acquire actually a gaming company.
That's what
On that note, could you use that to protect your market? And what I mean is this: like, if they get big enough and they buy the major game or a couple major game manufacturers, and they say, okay, well, now this game manufacturer is going to continue to release physical medium discs because we control the content pipeline, could they technically bend the market to where now they use gaming, functionality still there? Because one of the worries is that everybody's going virtual. Well, if they own the game companies, they can kind of force that a little bit, right?
Yeah, theoretically. But one of the interesting things we find is that, I mean, PS5 and the Xbox, their high-end console, it has a disc player in it. So, I mean, discs aren't going away in the next few years because the consoles have them in there. I mean, a lot of people do buy digital games now or download digital games, but 50% are
we're Gen Xers. We're not boomers.
I know,
50% of sales are still discs.
Yeah, I think it's really interesting because it reminds me of year 2000 internet bubble. There was a company called China.com. And just by nature of the name of the company, the stock price went up. They didn't really have a business. It started like as a...
Well, there's pets.com back then.
It was like a spin-off of some Chinese newspaper. Like they didn't really have like a web business. But because of China.com, they changed the name to China.com. Suddenly the stock price went up. And I don't know what ultimately happened to that company, but I remember looking at it saying, look at how much cash they have. They could actually go out and buy real businesses now. It was like in reverse, right? It wasn't like they had a business and went public. They had a domain name and had a stock price that allowed them to go out and buy businesses. So, yeah, interesting to see what GameStop's going to be able to do if the stock price remains at these levels. I have one question for Chris. Chris, can they issue stock at this price?
Definitely. I think you're going to see it soon. They're gonna issue a secondary offering. I mean, they just do 1 million shares, they raise $200-300 million, and they fortify their balance sheet. Yeah, and then if their stock collapses, they can buy the entire company back.
Yeah.
Wow,
that would be crazy. A great move.
I mean, if you remember back to last year, I mean, there was echoes of this kind of populist movement, and it was in Hertz, in the bankrupt stocks. People were buying Hertz when they announced bankruptcy. The stock went to 56 cents, and then when people piled in, it was trading at $5. And Hertz already had declared bankruptcy, and they Hertz tried to raise $1 billion on the equity market. A judge actually approved it, but the SEC stepped in and said you can't do that because they didn't want the retail investor to
get
basically.
hurt.
I mean, they were going to lose. The company was bankrupt, and you're going to allow them to raise $1 billion. So I would expect GameStop to step in here and issue equity because there's plenty of volume that people would buy it up. It would go in a second.
Okay, so to close all of this out, this is a unique situation. I know in the article, Andy, you wrote that you've never seen anything like it in your career.
Don't know that I will see another one like
okay,
this.
that was my thing. Do you think this is a trend, or do you think this is a one-time thing and there's going to be some regulations or things put in, whatnot, to prevent it from happening in the future? And then pitch yourself, inspired money or anything else you want people to know about.
Chris, you want to go first?
I got distracted.
Oh,
oh,
was watching TV.
Will we see another bubble like this? One interesting thing is that you have to give credit to whoever is investing, whether it's the retail investor or sophisticated, whoever they are, who either chased bankrupt companies last year and made money, or buying short stocks, highly shorted stocks. I mean, this is looking for market inefficiencies, right? And looking for opportunities to make money. It's just different ways to skin a cat, I guess. So, I mean, there's always different ways to try to do things. And it's like thinking out of the box and try to adapt. I think it's an exciting time. It's a scary time too, though, because it's not normal for a stock to go from $20 to 300 in 2 weeks. That I think we may never see again, but never say never. Maybe in 10 years from now we will.
Yeah, life just seems to be moving faster and faster. I mean, if I look back at my career, I saw the internet bubble, then I saw the subprime mortgage bubble. This is like a smaller scale, high short interest bubble. So we're going to see more of them. I don't know. Maybe we'll see more frequently. I think one of the challenges is that I'm not really sure how the regulators can regulate, because I don't want them to like shut Reddit down or say that you can't talk about investing on Reddit. I don't know what you can do without taking extreme positions as far as making rules for what people can or can't do. But we have heard some information that, the regulators are also trying to regulate the hedge funds too. And I think that doesn't make a lot of sense either. Rumblings of saying that the hedge funds shouldn't get their investment ideas on social media, or I don't think that they really do that anyway. So I'm not sure that the regulators even understand a lot of the problems. But yeah, we're going to see more bubbles in the future. And, I think most investors are best steering clear, like follow Warren Buffett, just buy the S&P 500 and then go fishing. And then you can just watch the excitement from the distance and try to resist FOMO. But if there's a bubble and you're involved, hopefully you're on the right side of it. But thanks, Eric, for having us on. You can find us at runnymede.com. That's Runnymede Capital Management. Or if it's easier to spell and remember, go to inspiredmoney.fm. Takes you to our same website, just to the podcast. But you can find us and learn more about us.
Chris, anything you have going? Well, you guys also do a YouTube channel, right?
Yeah, we also have a New Jersey-focused channel called Buy Local NJ, where we highlight great local businesses around New Jersey, and it's a cause that we feel passionate about, is just supporting those Main Street businesses, because if we all buy all our goods off of Amazon, it's going to change our downtowns forever. And these small businesses in our downtowns are the ones that support the schools, support local fundraisers, and create stronger communities. So we feel like local is more important than ever, especially in this crazy COVID time period.
Awesome. And everybody, thank you very much. If you like this kind of content, please consider subscribing. My show turned exactly 1 year today.
Congratulations.
1 year old. So
Congrats.
Let's see if we can get 14,000 by the end of the day, guys. Seriously.
Come on.
We're close. We're on the verge.
Pretend
to-
that bell is like GameStop.
Exactly. Just
Hit that
hammer
bell.
that. Well, if it's GameStop, then let's see if we can get me to $30,000 by the end of the day.
We can get you to
I will take
100,000,
that.
Eric. 100,000 by the end of
Okay,
the day.
100,000. Absolutely. Thank everybody